Hello and welcome to the Investing Master Series. My name is James Boyd. We welcome you on this November 4th. Beautiful day in Salt Lake, as Barb mentioned in the chat. Boy, is it ever. Hopefully I don't get a suntan today. And we'd like to welcome all of you here, as well as Barbara. We got Kevin with us, Ocean Life 26. We got Silas with us, Ray, and many others. A little joke that was in the chat. Barb, I think, did the flag kind of construction on my house last week. The Canadian flag, it is a beautiful flag. It's just missing the blue. Okay, Barbara's close. Okay, just put that blue on there. It'll be even prettier. Anyway, a little fun there. So we mentioned that in the chat. Remember, you can follow Barbara and myself on X. There's my handle. Barbara will post her handle right there in the chat. We do post educational content and announcements there. I'll also actually post to you some links in the chat in just a moment where you could actually touch base with us and connect online as well. Now, just real quick as we're getting going, I want to give us a quick reminder. Our goal that we're going to talk about here today is kind of, what I've learned about investing is you don't really know a whole lot until you get the volatility to go up. And what I mean by the volatility going up, the VIX going up. Once you get the VIX to go up, then you really identify and be able to help understand, are you clear on exits? Are you clear on stop adjustments? Are you clear in terms of maybe managing the portfolio and or position? That's where the learning really comes. So you can kind of take VIX going up as a negative, or you could say this is where you really learn to become more of a complete investor, not just buying stuff. It's how do you sell it? How do you protect? That's where you become more of a complete investor. Now, also remember when we talk about examples, they are just that. Also, when we talk about stock, we'll talk about stocks. We'll also talk about options. Remember that options carry a high level of risk, not suitable for all investors. Our option strategies that we cover are things like covered calls, married puts, or protective puts, callers, okay? We also talk about cash secured puts and verticals. Those are probably going to be some of the frequent strategies that we really discuss here. Now, also remember when we talk about examples, we will do those in the Paper Money software application for educational purposes only. Investing involves risk, including loss of principal. And also remember when we talk about short options, like cash secured puts or covered calls, things like that, those could be assigned at any time up to the expiration, regardless of the in the money amount. So if you had a covered call, they could take your shares prior to the expiration, but they still give you all the premium and up to the strike. Second, if you did the cash secured put, they could assign you the shares, which means you're the buyer of the shares at the strike price. They have to give you all of the premium, even though it's not at expiration. So that's really what that really means, okay? And also remember when we talk about examples, they're just that. Today, what we're going to really kind of focus on is kind of talk about these market conditions. Now, we talk about market conditions in different types of trends. Trends 1, 2, 3, 4, and 5. When you get trend 4, which is the price above both moving averages, the 10 and the 30, prices up at resistance, that can sometimes be a turning point where maybe the momentum starts to fade. If we get into trend 5, that's where the price dips down below the 10-period moving average. We lose momentum, and all of a sudden the stock or the index is falling down. Now, I want to kind of talk about a question that came up in the chat. And by the way, I love questions, okay? So just fire away. Now, one of the comments, and let's do this just real quick, was sometimes I do like pre-market analysis. And then what happened when I did the pre-market analysis, what happens in the first couple of minutes of the market is different than my pre-market analysis. Well, let's kind of take a look at this for just a sec with what I just said. You look at the SPX, can you tell me, this is yesterday at the close. Tell me what you would think would happen if we have the red line on the 10-period moving average. Is the S&P really bullish? I'm not showing you the candle yet today. This is where it was at the close yesterday. And by the way, the red candle has been on the 10-period moving average 1 day, 2 day, and 3 day. And you could actually say on the 3rd, yesterday, there's even a little crossover. So when we see this, we're thinking, hey, we're losing a little momentum and there's a little pullback. Now, we don't know what's going to happen tomorrow. But when we come into today, we're kind of thinking, hey, there's a little profit taking. Things are pulling back a little bit. The strongest index we had yesterday was the NASDAQ, okay? Then the S&P, but the Dow and the Russell had lagged, okay? So if we came in today and we woke up and said, oh my gosh, I'm just so shocked, we would say, wouldn't be that shocked, okay, because it was kind of red before today. It just kind of fell further. Now, if you take a look at the strongest one just real quick, the NASDAQ, pull that up. And if you pull up NASDAQ and say, where was it yesterday? Where was it? Did it also have like a red line there? The end of yesterday, yeah, did it cross over on the moving average? Not yet. But we actually go back and you look at that, it dropped today. But before today, there was a little red there. And again, one of the things we said last week, I know for sure I said this on Friday with Kevin, where we talked about a lot of things kind of look like they're extended. And when you get a lot of things extended, that means they've gone up in that bull flag pole. And, you know, there's a likelihood that they could consolidate a little bit, okay? Now, the biggest thing is if you look at, let's say, the Dow Jones, which we said was third, Dow Jones was even dropping before. That was yesterday. That was at the close. And if we look at the Russell, you're going to see that, man, just fourth place. You can't even see it. It's way back there. It's even redder. That was on Friday, October 31st. 2 red moving averages and a crossover negative. And there was yesterday. So I want to go back to kind of how the question was exactly worded, okay? And it was, now this is from Deep 7353. When I look at the market watch, visualize pre-market, and do my analysis, it turns out very different than how the market starts, and the analysis seems all wrong. Based on what we just talked about, it's kind of more of a continuation of what we saw in the last 2 to 3 days. The market didn't all of a sudden gap to the upside. It was different the last 2 or 3 days. It just kind of continued. So I would kind of ask yourself, like, were you expecting the market to bounce to the upside? Is that what you were expecting? Because that's showing differently than what the 10-period moving average was showing, okay? Now, let's kind of so any other questions there? Just want to make sure we first got that. Now, the other thing is if we said, okay, forget the indexes for just a second. If we looked at the VIX itself and we said, we're just going to look at the VIX and kind of tell us what you think is going to happen. If the moving averages on the VIX start to go green and we get the 10 to cross over the 20, we know there's probably going to be a little consolidation and or downside pullback. We don't know how high it's going to go up, if it goes up, but it's not the greatest sign. This is on the 3rd as well. If that VIX is actually going up, which it hit an intraday high yesterday, we're kind of in that pullback. Now, I've also seen a lot of people in the chat say, James, good thing I have my covered call. James, good thing I have my caller protection on. And, you know, that's when you're in trend 4. When you're in trend 5, that is when you're trying to use those strategies. Now, could the investor say, I don't use those and I'm just going to get stopped out? Yeah, they could. Or they can manually sell, okay? So that's someone who might be saying, look, I'm going to lighten up the portfolio. Or I'm just going to exit because I don't do options. Fine, okay? Follow that rule set for that investor. If you look at today, it's more of a continuation of what we really saw yesterday, okay? Now, when we kind of take a look at just real quick, so we've talked about the indexes. I want to kind of talk about just real quick, briefly, just quickly on the sectors. When we actually look at the sectors, if we took a look at this, now, by the way, I want to kind of pull this up just real quick, like right here, okay? So when we look at the sectors, we got trend 4, which means we're probably in a consolidation. We pull up the IXV, we're kind of in the consolidation. Now, consolidation does not necessarily mean it's all bad. It just kind of means that we probably haven't made a higher high, okay? And there's some resistance above us. So we're not saying that healthcare is horrible. I mean, just look at Cardinal Health, CAH. It's just kind of more of an ascending triangle. It hasn't broken out yet. When you pull up, for example, the financials, the sector, trend 1 on the real estate, Staples, trend 1. Boo. We got transports, that's trend 3, and you got discretionary trend 3. So the only 2 sectors we really see right now that are trend 3 are really discretionaries and transports. When you look at the stocks, it is also in trend 4. But the majority of what we see is trend 1. Prices below both moving averages. And what does that mean? Man, you've lost momentum and you've got pressure on the trend, okay? You're below both moving averages. What's the prediction? The prediction is pain. The prediction is pullback at that moment in time. Now, the comment is good time to sell puts on a day like this. Well, so when you get the VIX to go up, and the key word is when you get the VIX to go up and it gets above 18, when it gets above 20, when many of the indexes or sectors are in that trend one condition, some investors say, look, this is when I'm going to try to sell the puts. When the volatility is higher, the premiums could be higher. I would say this, okay? The investor tries to sell puts when the price is near horizontal areas of support and there is a bullish MACD divergence. Okay? So that tells you not that it's fallen, but there's also been some time where the momentum is trying to change back to the upside. Or you're just looking for something that just in general is still showing relative strength and is moving to the upside. Example given, like what? Well, if you pulled up, let's say, WFC and said, well, this is an example of something that's in an upward trend already, and it's showing relative strength compared to the index, the S&P 500, and the sector, the financials. Let me just go look at it. All right, now, so I'm not disagreeing completely. I'm just saying the timing probably needs to be a little bit better than just high volatility sell something. It's prices falling down to horizontal support, and there's a bullish MACD divergence that you could objectively identify, or hey, found something that's still in the upward trend despite what the index and the sector is doing. That makes a little bit more sense. Now, what I want to do just real quick is I want to come through a couple examples quickly, okay? Now, what I want to kind of show is, so example given, okay, a couple stocks that I want to kind of just pull out just real quick. So first off, we got, and I'm just going to look at just real quick, some faster than others, okay? Cisco, 201 shares. And I just want to go back and look at this. It's still showing trend 3. And we're going to go top to bottom, okay? But if I look at Cisco for just a second, said, is Cisco still grinding to the upside? Or is there maybe some reasons to be a little bit more protective? Now, by the way, just because it's trend 3 doesn't necessarily mean it's a bad time to protect. Why? Why would you say that? No, once you get inside maybe 7 to 10 days before earnings, the investor might say, James, we might kind of hit a short-term high, and this is when we're going to make a decision. Oh my gosh, people struggle to make a decision, okay? Not this group. But if we're kind of maybe at a point, now it hit the 161, okay? That was the extension target, that 74.5. Now, we're not saying, oh, we're so late. It would have been nice to do this maybe a dollar ago, but we're going to make the decision that hey, we're going to hold Cisco over the earnings, which is probably coming up next week, okay? So step number 1 is when we put on protection, one place that we would like to put on protection is at the target area, at a resistance area. Why? Does anybody know why I said that? Why is that the number 1 place to put on protection if the investor doesn't want to sell the shares? Answer? No, because the price hasn't fallen yet. This is when the gains on the position is at the highest point. It hasn't fallen yet. So if you're going to say, look, I'm not going to sell a target and it hasn't fallen yet, those gains are actually at the highest point. They're unrealized gains. And the investor's making a decision, hey, I'm going to put on protection. Well, remember, let's go back to what we always talk about. 20 to 50 days expiration, sell the call out of the money, probably delta 30 to 40. Buy the put out of the money below the current stock price with a delta of 30 to 40. Now, let's actually go hurry and do it. Now, this is not new, but now we're just going to execute what we already know. There's a difference between knowing it and doing it, okay? Now, what I'm going to do is I'm going to go down to the 20 to 50 days expiration. We like monthly options first because that's where we tend to see more liquidity. Now, I cannot express this enough. I've seen lately ticker symbols that are just horrible in terms of liquidity on the stock and the volume and the option volume. Now, your criteria might be different. But the paper money account is trying to focus on things that trade millions of shares average volume and has a tight bid-ask spread. Sometimes we kind of say something like 20 cents bid-ask spread wide, let's say 350, 360. I'm fine with that. The goal is as narrow as possible. I think a little bit more definitive would actually be that the open interest is in the thousands, okay? If we get open interest in the thousands, that's a better chance to actually have tighter bid-ask spreads, okay? Now, why don't I like the 20 cents? Well, because if we looked at a $1,000 stock, it might not be 20 cents. If we look at Bank of America, there's a better chance to be 20 cents or narrow on the bid-ask spreads. I just like to kind of say the open interest is in the thousands. Now, if we sold, let's say something with a delta between 30 to 40, it'd be the 77.5. And if we bought the put with the delta out of the money, delta 30 to 40, it's going to be sell the 77.5 and buy the 70. Now, what we're going to do is if we have two contracts, do we have to do two contracts? The answer is no. We can do one contract. Why would you do that? Well, you're trying to have it where the 100 shares of those 200 are not capped. But if the investor says, you know what, James, I actually do want to cap both those shares, and I am fine with capping those shares at 77.5. I mean, how greedy can you be? If the stock is at 73, you're capping the upside at 77.5, and then whatever the net credit might be. In this case, there's not a net credit. We're going to right click right there on the bid, sell, and we're going to go right to where it says caller. So we already have the shares there. Notice there's a stop or something on there. We're going to go in there and we're going to cancel these orders. Cancel the OCO group, cancel the OCO group. And so now what's going to happen is in this IRA, we're going to go in and say, look, sell the 77.5, and we're not going to do one of them. We're going to do two of them. Okay. Now, is this correct? No, it's not correct. We got to make sure the put strike is correct. Now what we're going to see in this case is we're going to come down here to the 70. Now that's correct. Now this is what folks call a zero cost collar. Now, it sounds great, but what is that really saying? Well, the debit is close to zero or zero. The cost is really the commission. The commission is really going to be $260. Why is it $260? Because you got two contracts, but you're selling a call, buying a put. So it's really, that's why it's not $1.30-ish for one contract. But the biggest thing is it's more the opportunity cost. What do you mean by that? Well, you're capping the upside to $77.50. Get up to $77.50. And you have the right to sell those shares at 70. Okay? Now, what this is doing is if you had 200 shares of stock and we sell this call and buy the put, it's making it where the delta becomes less. Can anyone tell me why does someone want the delta less? One main answer is they might think the stock is at the top in the short term. Second is they don't want maybe something that's news related like earnings to cause them to like really get this position pushed down quite a bit, and it just gaps down like Uber did today. What the investor is also trying to do is they're trying to hold on to these gains and get over earnings, okay? So this 632 is what the profit loss is right now. So if the stock goes down $1, that loss is going to be about $77-ish. It would lose about $77. But the gains on should still be right around $560-ish. Stock goes down $2. Well, it's going to be about $77, $154-ish. We're going to be probably about $480. Okay. Stock goes down $3. It's probably going to be right around, I don't know, $225-ish. I'm rounding. And it's going to be right around $408. So if we have a $3 gap down on the stock, at least there should be a little money left for he or she in this position. Now, they're giving some money back. But if they didn't put on the collar and this stock went down $3 and they have 200 shares, if the stock went down $3, just $3 on 200 shares, that means they would have actually lost or given back $600. Now, there's nothing worse. Okay, this is like doing push-ups and lemon juice. If that stock went down $3 over earnings, gone. That unrealized profit of $600, like smoke, it's gone. Now, if the stock actually goes down $3, there should be a little left in the cookie jar. Now, I'm not sure if you like cookies. Some people do. When I say cookies, there's some unrealized profits that could be there still. Now, this is very important, okay? So we're trying to learn how to manage earnings events and get through them. So on trade number one there on Cisco, okay, that's kind of important. Why do we actually talk about that? Because it hit the target. And it's also, by the way, the target, if we're talking about trying to put on protection, this is when we're expecting investors to profit take. We're trying to put on the protection at the target if the investor decides, I don't want to sell, but I know those profit takers are likely going to come in and we're inside 2 weeks to earnings. Okay? Now, yeah, obviously, Ocean Lights, yeah, pain, right? Now, what I want to do just real quick is I want to kind of show one more position. And I do want to come down to this NEM in just a moment. We have done these callers here. We'll touch on those. One that we need to address just real quick here is the Apple and the COF. Now, Apple has gone up fairly decently, okay? Sold the put, okay? Now, remember, this is a strategy that we're going to do frequently. And we sold the 252 put. We collected a premium. And that premium was $425. That premium represents the most the investor can make. So how do we actually make it? We don't not just collect it, but make it. Well, stock goes up in value. That could decrease the puts. That'd be good. Sell the put when it's high and buy it back when it's low. Time decay goes by and the volatility. So direction up, time goes by, volatility, okay, goes down. Like a balloon, okay? Now, what you're now going to notice is it was $4.25 when it was sold, and now it's at 89 cents. The only way you get the 89 cents is the stock goes way up, okay? You get closer to zero. That's the goal. You're trying to keep it all, if you're trying to get it all, or you got to wait all the way to expiration. Here we have 17 days left. We're at 79%. We always kind of talk about a minimum of 50, 65% if you have more than, let's say, 50% minimum, 65%, 80 would be a really good goal, especially if you get 80% ever, irregardless of the number of days expiration. And what you're going to see is we're sitting on it. We're going to right-click on this, and what we're going to do is we're going to buy the call back. Right-click, buy the call back. Excuse me, not buy the call back, buy the put back. And we're going to buy it back. We're giving some of the initial credit back. Now, what you're now going to notice is if you said, James, could you reference where that put was sold? October 21st. Feel free to go back and take a look at that on the chart. We're going to pull this up, and we're going to say, look, we're going to buy it back for 86 cents. We're giving some of the initial credit back and paying a commission. Now, what you're now going to see in this case is we're going to send it. And if we go back to the chart, let's show where that October 21st was. So we can see that. Pull that up. October 21st. Where was it? It was right there. So it was really, if we go a little back and we're trying to say, when was this trade placed? It was placed on a breakout day. The very next day it went down, and then the very next day after that, slightly up. But you're now going to notice is the entry was a breakout and the exit was really just a crossover to the downside, okay? And it was also with that crossover to the downside, it was the price getting below the 10-period moving average. That's when the investor is most likely exiting, maybe for potential gains, or exiting for losses, okay? Now, if we take a look at this, I'm also going to go back to just one more just real quick, which is the COF. Now, the COF, now, by the way, I want to kind of reference one thing just real quick. If the put itself is maybe worth more than a nickel, could it make sense to sell that put and try to grab that 17 cents? I think that's fair. But if they're not worth 5 cents, you just got to understand it is like you kind of reach the point where they're not really worth anything. So I could say that. We won't do that for time's sake, but I just want to point that out. That might be worth selling or trying to if you can get 17.5 cents. The other one I want to point out is if you look at the COF, sold the put at 200, was at 355. It's at 102. It's at 71%. Now, this one too, the put that was the downside protection, it's at 47 cents. Would that be worth to maybe try to get out? Yeah, there's something left to sell. Why is there something left to sell? Well, because there's 17 days left, okay? Now, could we also maybe just try to get out as a classic vertical? Yeah, good. Let's go back to this before we look at some new positions. When was this trade placed? Now, what you're going to find is a lot of your trades are kind of placed around each other. In other words, if the market on October 21st was breaking out, you go back and look at your portfolio, a lot of your trades are probably placed around the same time. If we pull up COF and said, what did it look like? 1021 was right here. Now, here's what's kind of so funny about cash secured puts or long call verticals or short put verticals. If we said, man, great entry, the entry was really post the earnings, kind of in maybe a little reversal. Moving averages were green shade, right? Kind of a trend 3 condition. And if you look at that and say, did it really go up that much? The answer is $5 whopping. But actually, there's a little change there that the paper money account might stuff in its pocket, and it's $160. Not a ton, but what Barbara would call a base hit. Now, the Blue Jays, they were incredible until the last couple innings. And then the Dodgers stole it from those Toronto Blue Jays. Was an interesting baseball game, especially if you don't watch baseball. But LA wins again. Now, if we take a look at this, create closing order, we're going to buy it back. Now, why are we including that long put? We're including the long put because it still is 47 cents. Now, they played. Now, my team's Nebraska, so don't even get me started on that. We haven't won anything for 10 years, okay? So if anyone wants to feel bad about sports, it's me, okay? But at least they were in the World Series compared to the Yankees. Now, if we take a look at this, we're going to get out, and what we're doing is we're buying the put back and then selling, we're selling the 185, okay? So we're buying that back and we're getting it out for a debit. So we got in this trade for a credit. Okay, we got in for a credit. And what we're doing is we're getting out for a debit and we're trying to harness or capture that amount right there. Confirm and send. Now, if we went back and said, well, what does this look like now? You're going to notice that it's another example of selling when the 10-period moving average is what color? That's correct, red. It's another example of selling when the moving average crossed over. Look, people have said to me over 25 years, I'm not very good with selling. I disagree with that. I think people do know when to sell, but they don't follow their own plan and execute it. They know down inside when to sell, but they're like, if I sell, I got to make a decision. That is correct. Okay. Now, you could say, I'm just going to close my eyes for the next 17 days and get a forced decision. And with that forced decision, I get to keep all the premium, or I get to maybe own the shares, or I actually, for example, have a max loss. So in other words, it's just now a force. Close above, own the shares, or for example, a max loss. Okay. And here's the deal. We're investing. This is making a decision. Okay. So understand this, that if you want to become better with technicals, this is when you're in trend 4 and 5, this is when you really grow as an investor. Can you execute the exits? Okay. It's not buying stuff. When the market goes up and everything is Krispy Kreme, it's just Kentucky green grass. You can kind of just ride the momentum. But when it pulls back, that's when you see the differences between investors. Okay? Now, I want to go back. Are there any questions? Yeah, look, here's the deal. The Blue Jays, I would have to say, I'm not even sure if I think the baseball world was just surprised in general. Now the records were the same, but I mean they took the Dodgers to the brink. I'm not a baseball fan per se, but I think it was just very good competition. I love watching things that are competition. Yeah, and they did earn it, but I mean, someone wins, someone loses, but overall, it was a competition. There's no doubt. Okay, and so now the comment is, let's also go back to just real quick other examples. Now, let's go back to this just real quick, okay? Now, one of the stocks that's kind of showing some relative strength. Now, if you said, James, I'm not really clear on relative strength, well, number one is you could have a list of financial stocks, and you could look at the statistical return differences on the 1 week, 1 month performance. And if Wells Fargo is strong in the 1 week or the 1 month or the combination of both compared to the sector, well, it's showing relative strength at that moment in time. You could also pull up, let's say, the relative strength or column headings in general. You could pull that up as well. But the other way you could actually do this is if we just put on the bottom relative strength. The relative strength is defaulted to the SPX. If I did this and said, hey, is the green line going up when the red line, so that's the performance of actually the WFC, and the red line is the SPX, the S&P 500. So that's the benchmark, okay? That's why it's the red line, the benchmark, the hurdle. And if that line, that green line is going to the upside, there's relative outperformance recently. Now, if we said, well, James, could I take that back and type in IXM for the financial sector, which you could maybe take a different ticker to, sure. And if we looked at the same type of idea now for what it's showing, I can't get it to show up on the IXM. But you know a ticker that we talk about every Friday, starts with an X, ends with an F, okay? You fill in the blank. You could say, is the green line also going up as well? The red line would be the sector itself. Now, what we're going to show in this example, let's imagine that I said to you, James, whenever I see the VIX go to the upside, I just become deer in the headlights. I'm just scared, okay? Now, I'm going to kind of play that, okay? So one thing that we could try to do is, let's say the investor says, look, I'm seeing a stock that goes to the upside, but I'm just so nervous. Okay, fine. So what we're going to do is we're going to come in here and we're going to go to the WFC. And what we're going to now do is we're going to click on the ask. Now, when the VIX goes to the upside, it does become a little bit more treacherous. What do I mean by that? Well, what I mean by that is when the VIX goes to the upside, VIX goes up, the market goes down, up, down, up. And you kind of have this washing machine of price action. Do you know what I mean, or do you want me to go further on that example? Have you ever seen the VIX go up and you just see these big price swings? You ever seen that? You ever seen where it goes up for 1 or 2 days and then slams back down? Up 1 or 2 days, slams back down. When the VIX goes up, you have the greatest statistical chances of being stopped out of the position. Greatest statistical chances. Now, many investors say that's why I don't like to actually do stocks in that situation sometimes with setting stops, because they could actually take a good position, a good entry, but the volatility in the market causes the price to go up and down, stomps them out, and only sometimes to see the price go right back to the upside. So they had the idea, but it was that dadgum volatility that just stomps them out. And then they get frustrated. Let's switch that up a little bit. Maybe could we actually say, look, we're going to buy the shares of the stock, but then at the same time, we're going to buy the put. Now remember, the put's different than setting a stop. That stop could be there for a while. The put is only there for till expiration, or unless you exercise it. Now, we're going to actually click on to buy the shares. How do you do that? Click on the ask price to buy the shares. Not that hard. So it defaults to 100. Now, what we're going to do is we're going to click on step 2. We're then going to say first triggers SEQ. Now, when we do this, we're going to accompany the shares of stock with buying a put. And the buying the put gives the investor the right to sell the shares from now until expiration. Now, we would like our example of the puts to really kind of be the strike that we pick that really have the highest open interest, maybe in the thousands. Well, on the something more than 20 days, I don't see it there. Nothing. Close that one up. What about this one? Nothing. Well, what about this one? Zeros, nothing. And we go down to the 19th of December. Oh, there's what we were talking about. That is why we start with monthly options. That's when you're going to find more often than not. Look at the monthly options. That's probably where there's the liquidity. Now, if we went down to, let's say, the strike of, let's say, the 85, you're now going to see that if we buy the put, how much does the put cost? $228. Now, the implied volatility is 30, and in this case, you're going to see that we have a situation where that strike is at 85. Now, let's put the math to it, okay? Now, if we buy those shares at 87.89, and the strike that we buy is 85, the difference between those two is just going to be 279. So that's what that risk is. $2.79. Is everyone with me there? You with me? $2.79. You good? Okay. So if we did that and said, okay, if we lose the difference between 87 and 79 less 85, it's the shares is 279. Now, the question is, well, how much are we buying the put for? Well, if you paid 228 for it, you're paying another 228 for it, 228. You got to add those two together. This is the stock loss from stock entry to long put strike. Okay. Now, what is the 228? This is the long put premium. And if we add these two up together and say, well, if you add them up, what would it be? It is going to be $5.07. Now, I don't know about you, but some investors kind of like to look at how much is that put on a percentage basis. Now, how do we know that? Well, we take that put, what we pay for it, 228, and we divide it into the current stock price as we're looking at this. So if I did this and said, what's that percentage? It's 2.5%. Now, for some investors, they say, no, absolutely not. I'm not going over 2%. Why does it matter? It matters because if you buy the shares at 87.79 and you pay, okay, you pay in this case $279, you have to get the stock to go up to 90.58 to break even. That's just to break even. This is the stock entry price. That's the what you pay for the put. That's the break even today. No, it's the break even expiration. All right, now, if we said, now I need some help here, okay? Help me out here. If we said our rule of thumb is we will not pay more than 2%, what are our options? What are our options? What can we do? Now, why is this put a little bit higher? Well, number one, the VIX is up. So that's going to be reflected in the stock, in the current stock as well. The other thing we could actually do is we could just say, look, could we do maybe a lower strike? Could we? Well, let's go look at it. Now, there's going to be some offset here. Well, the put does not have a delta between 30 to 40. It doesn't. And it has a delta 25. So it's not going to be as protective, which means when we go look at the loss is going to be a little bit, it's going to be more. Now, I'm going to leave the numbers that we did up top, and I'm going to type in not the 85, but the 82.5. And what we're going to do is we're going to say, look, we're going to buy those puts for $1.53. That's the ask price. And so if we pay $1.53, you're now going to see, yep, and I typed in the wrong box. If I did that, so we have from 87.79, which is the current stock price. The 82.5 is the strike price that we're looking at. So we could lose $5.29 on the shares. Are you with me? And we said that's the stock loss from the stock entry price to the long put strike. Now this is where we want to type in what is the long put premium. The answer, $1.53. So if we look at the first example, it was a max loss of 507. If we look at taking a lower strike on the put, 82.5, well, it's going to be a max loss of 682. Now, is it massive? No. But what we care about is how much money we're putting out. In this case, we're putting out 1.74% of the current stock price. Now, when we look at the break-evens, when we do that, we see that the break-even in this case is, survey says, 89.32. So you're going to see that the max loss is a little bit more. True. The break-even is lower. Noted. Okay? Now, this is how some people, when the markets are more volatile, now let's kind of get out of one of the comments that I hear sometimes. Hey, James, I got in, the stock went down, and now I'm out of the position because the stock is below the long put strike. No. This is not a stop. This is the right to sell the shares at the stock price, at the strike price, excuse me. And so what that means, if the stock goes below the strike, you have the right to sell the shares at the strike price. Because just because the stock goes below the strike price doesn't mean the investor has to sell. They have a right to sell contractually until expiration. Now, here's what I want us to do. I want you to pick. Now, I'm going to do this trade. Now, why am I going to pick the 82.5? Because in our example, we do not want to pay more than 2% for the put, okay? Now, if you said, James, remind me again where that 2% came from, I'll tell you where it came from. It's the option premium divided by the current stock price, okay? Now, James, could you do one more of these? You darn right I can. Now, if we look at the max loss, in this case, if we lose 682 and we're buying the shares for 87.79, remember, this loss right here, in our example, we don't want that loss to be any more than 8%. We're trying to limit losses to 8% or less. Okay? Now, we could talk about that, but we won't. How do we get that? Well, let's write it out so we can all follow along. It's going to be the max loss divided by the current stock price. And when we say the current stock price, we're talking about right now. Okay? So here's what we're going to do. Okay, so here we go. I'm going to come in here, and we're going to buy those shares of stock. We got it slated there. First trigger is SEQ. How do you buy the put? We're going to go to the ask price, ding, and we're going to click on it. This right here is called a married put. Now, don't tell me you haven't done this in your life. You already have. Think about things in your life. You bought something, and at the same time, you bought protection. But here, it's not just a gadget or something like that. It's a paper asset. It's a stock. We're buying the shares, buying the put. And now what we're going to do is say confirm and send, and it's a married put. That risk profile diagram is going to look like as follows. It's going to show a max loss, and it's going to show an unlimited upside. That's if it went to the upside. Now, there's no cap, in other words. There's no obligation. So we don't know if it's going to go up, but if it does, there's no ceiling. Okay, the ceiling is infinity. Now, if we take a look at this, we're now going to come back, send the order. Now, I'm going to go back to one other stock that might be showing. Now, I'm going to choose something a little bit less. Now, some of you as investors, you might be thinking, well, James, can I do this on maybe a lower price dollar stock? I'm a little nervous. When I learned how to swim, I didn't go in the deep end. I went to the kiddie pool end of the pool. Well, let's do that. The kiddie pool end of the pool, in this case, is a lower price dollar stock. Let's show this example in 1 minute or less. Well, if these shares have 53.61, let's go back and punch the numbers. 53.61, what's the strike you're looking at? Well, if we went down to the trade tab, typed in BAC, same thing, went to go look at the delta of, let's say, 30 to 40, I got the 52.5. 52.5, okay? The stock loss, we already talked about that. What's the long put premium? The long put premium there is $1.51. Type her in. 151. What's the max loss? Well, let's figure it out. Let's see if this is an opportunity here. And what you're now going to notice is, in this example, like the other one, it's too much. It's too rich, which means we're going to have to go a lower strike price. What's the lower strike price? The 50. So now we're going to type in the 50. What's the premium? The premium is 78 cents. Type in the 78 cents. Is it below the 2%? Yes. What's the max loss? Boy, it's right at 8%. It's actually 8.2%. Dramatically higher? No. How do you put the position in? By the way, what's the break even on that? Well, the break even on this is going to be, as we wrap it up here, 54.39. Okay? Now, if we bring this up, we're going to click on it, ask, single order, first triggers SEQ, and then click on that. Right on the put that we're going to buy. Now, your homework assignment is I want you to do 3 of these. So when the volatility goes up, a lot of times people get deer in the headlights, but wonder if we could use stocks and the long put combined to try to take advantage of volatility. I did the math here today on a sheet of paper to try to help you kind of see the math and kind of some of the metrics that we're trying to stay below for our example. Hopefully that was helpful. Let me know if it was. If it wasn't, don't tell me. I'm joking. You can tell me too. Now, also in the chat, there's a survey. Please click on that. And there's just 2 questions on that survey. If you enjoyed today's session, hit the thumbs up right on, just right on the thumbs up. And also you could subscribe right to our webcast as well. Now, remember, with what we discussed here today, it was done for example and illustrative purposes only. Cameron May is out today, so Ben Watson will be filling in his steps. Barbara Armstrong will be coming up later in the day talking about technical analysis as well. So join her and Ben Watson as well. Ben is coming up next, Barbara later in the day as well. So thanks so much for your comments and your participation as we talked about being a little bit protective with married puts and also showing some past trade examples as well. This has been the Class on Investing Master Series. With that said, have a great day. Take care. Bye-bye.